Ladies and gentlemen, good day and welcome to State Bank of India Q3 FY21-22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pawan Kumar Kedia, General Manager, Performance, Planning and Review, State Bank of India. Thank you, and over to you, sir.
Thank you, Aman. Good evening, ladies and gentlemen. I am Pawan Kumar Kedia, General Manager, Performance, Planning and Review. On behalf of the top management of SBI, I extend a warm welcome to all joining us today and on SBI Q3 FY22 conference call. On the call today, we have with us our Chairman, Mr. Dinesh Kumar Khara, Mr. C.S. Setty, Managing Director, Retail and Digital Banking, Mr. Ashwini Bhatia, Managing Director, Corporate Banking and Global Markets, Mr. Swaminathan J, Managing Director, Risk Compliance and Stress Asset Resolution Group, Mr. Ashwini Tiwari, Managing Director, International Banking, Technology and Subsidiaries, Mr. Alok Chaudhary, Deputy Managing Director, Finance, Mr. Charanjit Atra, CFO. Before I request our Chairman, sir, to give a brief summary of the bank's Q3 FY22 performance and the strategic initiative undertaken, I would like to read out the safe harbor statement. Certain statements in these slides are forward-looking statements. These statements are based on management's current expectations and are subject to uncertainty and changes in the circumstances. Actual outcome may differ materially from those included in these statements due to a variety of factors. Thank you. Now I request our Chairman, sir, to make his opening remarks.
Thank you. Very good evening to all of you. It's a pleasure to connect with you once again, virtually amidst the ongoing pandemic. Thank you for joining this conference call on a Saturday evening. I would like to start by thanking all our stakeholders, including our customers, shareholders, employees, and the broader ecosystem which has been supportive of our effort and initiative in our banking journey. For the last 2 months or so, we have seen a sharp increase in COVID-19 cases due to new coronavirus variant Omicron. However, its effect has been nowhere as deadly as the second wave, thanks to the government's massive vaccination drive, including precautionary booster dose for certain categories. The extension of vaccination to the age group of 15 to 18 also has contributed to better preparedness in dealing with the virus and return to normalcy. The quarter 3 of the financial year 22 results further validates that the bank's performance is improving steadily. I would like to highlight a few key indicators of our performance, which are essentially relating to the bank's profit for the quarter has increased to 8,432 crores, which is a YOY increase of 62.27%. Operating profit has also increased marginally by 6.86% YOY. Our ROE has improved from 9.49% to 14.01% YOY basis. Our net interest income for quarter 3 of financial year 22 is up by 6.48% YOY, and our domestic NIM is up by 6 basis point YOY, even as the CD ratio is at 60.89%. We believe that these are an outcome of the bank's focus on profitable growth, given the trust our brand enjoys, our heritage and our reach. We aim to deliver best value to our customers while being profitable. As I have said in my prior interactions, we'll lend at price point which add value to all of us. The gross NPA ratio of the bank has come down from 4.9% to 4.5% on a quarter-on-quarter basis, while the net NPA is at 1.34% for quarter 3 of financial year 22. The net NPA stands at 34,540 crores, and additional provisions not included in net NPA are 30,089 crores. The bank's operating profit for 9-month period, including additional provision, is 2.48 times the net NPA levels, which makes it one of the most resilient balance sheet in the recent years. Our slippage ratio for 9 months financial year 22 is at 1.16%, while our slippage ratio in quarter 3 of the financial year 22 is 0.37%. This is largely an outcome of the critical changes that have been made in our underwriting processes through the last cycles. Further, it highlights the inherent quality of the bank's underlying portfolio, which continues to be one of the lowest RWA portfolio in the industry. The CET1 ratio of the bank is at 9.38% at the end of December 21, and if we include the profit earned during the year, the ratio stands at 10.32%. We believe that the internal accruals are adequate to support the credit growth through the financial year 23. The bank's journey towards digital leadership continues and is adding significant value both for the bank and to its customers. The bank's super app YONO is gaining strength by addition of new features. From a longer term perspective, I would like to highlight that we are one of the best managed institutions in the country. Our management quality and the bandwidth enable us to efficiently manage the scale and complexity of our business across the globe. We continue to attract the best talent in the country. In fact, SBI Probationary Officers exam is one of the most competitive exams in the country, with an intake ratio of 0.2% compared to a 1% intake ratio in the common admission test for the leading management institutes. In the recent past, a number of our top executives have gone to head both public sector undertakings, private sector banks, and also FIs. Our team is committed to deliver 15% plus ROE consistently over the long term. As credit growth picks up, we expect the profitability ratios to improve further. While the longer term prospects are clear, now in the last quarter, we would still prefer to wait before giving guidance on key variables. To wrap up my opening remarks, I would like to thank you all for your support to the bank. We remain committed to reward your trust in us with superior sustainable returns over the long term. I wish everyone very good health and prosperity. My team and I are now open to taking your questions. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Mahrukh Adajania from Edelweiss. Please go ahead.
Hello, congratulations. My first question is on recovery. So, excluding interquarter recoveries, what would be the gross slippage in Q3? So in the first half, you already had interquarter recoveries of 8,000 crores. So what would that figure be for 9 months or just for the third quarter?
See, as far as we go for the net slippages, that is what the industry practice is also, and our net slippages are 2,334 crores for this quarter, which we have already shared. Yes, of course, we had a challenge in the first quarter when our slippages were as high as 15,666 crores, but we have recovered all those slippages well in time, and now as the situation stands, we feel that our slippages are hardly any, and whatever little is seen, that also we're in a position to recover well. And even SMA1 and SMA2 also is at a much lower level in the month of December 21, and in fact here also we are witnessing a pretty strong trend in terms of recovery. So I think that is one of the reasons why perhaps slippages are not as much of a worry for us.
Sir, yes, but sir, is it possible to have a figure like we had a figure of 8,000 crore of first 2 quarters recovery in the second quarter? So can we have a similar number for the third quarter or for 9 months?
In fact, that was a very unusual situation which we saw in the first quarter, and that's why we were tracking the recoveries very closely. But since now the slippages are not as high, so we really don't work out like that. But nevertheless, I'll ask the department concerned, if at all they will have some number, they will share with you separately.
Thank you, sir. So, my next question is just on the rate outlook. So, market rates are hardening. Now, just in terms of loans and deposits, so for loans, how much of your loans would be repo linked? Of course, external benchmark, but within that, repo linked, because that would reprice only when the repo changes.
See, we have repo linked loan is just about 0.24%. Our external benchmark link loan book is about 22%.
How much, sir?
22% is a repo
EBLR.
Is a EBLR link. It is essentially repo, and repo or the T-bill is either of the two. That is how it is. It is 22%.
Okay, sir. So, but most of this will reprice only when the repo is high, right?
No, if at all it is linked to the T-bill, then it will be at as and when the T-bill rate moves.
Got it, sir. So, and just in terms of deposits, so the growth in savings on a sequential basis this quarter has been a little under 2% on a sequential basis. So, do you visualize a situation given hardening rates that in the next 2 to 3 months you will have to increase your savings rate? Because if you are increasing your term deposit rates, then the repricing is only incremental, but savings it will be outstanding, right?
I think we will not be resorting to increasing the savings bank rate. We will rather be looking at certain maturities where in the term deposit buckets. But yes, of course, much of it will depend upon the behavior which we'll see on the ground. But we don't plan to increase the savings rate.
Maruk, is the question answered? Thank you. Our next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, good evening, sir. So firstly, in terms of the overall growth on the corporate side, so last couple of quarters we have been highlighting that there would be utilization of the working capital limits. And when we see it across the industry, I think the larger part of growth is coming in from the petroleum and the other industries, while I think deleveraging is continuing in the iron and steel, roads, transport and all. So now how do you see the outlook given maybe government is also putting a lot of trust on capex, and overall how would we participate in terms of the corporate credit growth given the competition? Yeah.
I would like to give you some kind of a color in terms of the underutilization or the unutilization which we have seen in the working capital cycle. As at the end of September 21, we had a situation where the unutilized limits were as high as about 52%. So from there it has come to about 43%. So which means that the unutilization or the underutilization has come down. So, but having said that, still we have got the unutilized limits of as high as about 2 lakh crore as far as the corporate book is concerned. Even term loans also, there is a slight improvement in the undisbursed term loans. But yes, of course, I think we will have to wait and watch for the improvement in the utilization as far as the term loans are concerned. As far as the infrastructure spend is concerned, of course, what we have seen in the growth till now, they were into various state government enterprises which are getting into various kind of infrastructure spending. That is one of the major component, and apart from that, the utilization which we have seen is into various core sectors. That is something which has been seen, and even the infrastructure sector also we have seen a decent growth. So going forward, I think the kind of the underutilization which is coming down, and also the trend which we have seen in the month of January, we hope to see it sustained. And if at all it sustains, then perhaps we will witness much decent credit numbers than what we have seen in the third quarter.
But it is not unwinding because the first fortnight number shows some unwinding in the bank credit overall, but that's not the situation for us and we expect it to sustain.
As far as I don't know about the banking system, but we keep on reviewing our numbers on an ongoing basis, and there we see very healthy trends.
And on international and overseas side, there is a decent traction. So now what is the outlook out there? We had seen a good growth on a quarter-on-quarter basis as well as year-on-year. So what is the nature, and do we see pursuing the opportunities maybe for the Indian linked corporate overseas?
No, this financing is essentially trade finance, which has been done. It's a 21% increase, which is coming as essentially trade finance. And the local loans which were done in these geographies. We are primarily focused into USA, UK, Singapore and Hong Kong. These are the major territories where we are growing. So I hope, and apart from that, we had started a new line of activity which was factoring. So that has also given us a decent growth. Hopefully we expect to see a similar trend going forward.
Okay. And one last question in terms of the standard asset provisioning, is it more towards the restructured pool or the increment which is there, maybe 500, 600 crores would be because of the increase in the loan book, but balance would be towards the restructured book?
Yeah, it is essentially relating to one of the account which we were seeing that it is under some stress, though it is still a standard account, so that is one of the reasons. And mainly it is on account of that and some bit of a restructuring too.
Okay, got it. Yeah, thank you.
Thank you. Our next question is from the line of Mona Ketan from Dolat Capital. Please go ahead.
Hello. Yeah, hi sir. Thanks for taking up my question. So firstly, on the cost to assets for 9 months, it stood at about 1.8% for SBI. So where do we see this moving over the near term? Could it normalize back to the 2% levels we have seen earlier, or could it remain where it is?
Cost to asset ratio would be 1.78. Yeah. It is somewhere around 1.78 now. It has come down from 1.95. So I think I expect it to come down actually once we have the balance sheet number growing, and also it will not lead to much of an incremental cost for us. So I think I expect it to improve further.
And also digital adoption.
And also there's a lot of digital adoption which is happening. If I may say so, about almost 40,000 crore worth of book has been underwritten in the current financial year through the digital medium. So there the cost is quite negligible, and we are trying for end-to-end digital, so it will further come down.
Sure. And on the restructured book, the presentation mentions of 33,000 crore. And once we include the non-COVID MSME restructuring under the earlier relief scheme and adjust it for any overlaps that we have with the current COVID-related restructured book, where would the total restructured book stand for us?
40,000. Total restructured would be around 40,000 crore.
40,000 crore.
Yeah. Restructured per se is 32,000 plus whatever are the minimum previous book.
Sure.
The previous book, if at all we will reckon, it will be around 40,000 crore.
Got it. And finally, where does the total ECLGS disbursement stand for us today? And if you could give what was it last quarter as well? Thank you.
Sorry, I could not get your question. Can you please repeat it?
ECLGS disbursement.
Acha, ECGL.
Yeah.
Disbursement, the outstanding is around 31,000 crores now.
Okay. And where was it last quarter for us? Or how much did we disburse in this quarter?
We were at 27,000 is additional disbursement during this quarter.
24,000.
Yeah.
Okay. Thank you and all the best.
Thank you.
Thank you. Our next question is from the line of Akash Jain from Ajcon Global Services Limited. Please go ahead.
Congratulations, sir, on a fantastic set of numbers in this quarter. I had a question regarding recoveries. Sir, what would be the recovery from written-off accounts in this quarter?
Yeah. Quarter is 1,500 crores. 9 months is 5,600 crores.
Okay. And what are we expecting from NCLT accounts in terms of recoveries in coming quarters?
We will not be differentiating between NCLT, but overall we are expecting a recovery of about 8,000 crores this whole financial year.
Okay. And sir, I wanted your outlook on the MSME book. Going forward, what do we foresee in the MSME sector?
We expect the book to look even better going forward.
Okay. And
we are focusing on the vendor finance and dealer finance in a big way. So that will help us in improving the quality of this book.
Okay. And in the corporate book, which sectors are we seeing green shoots apart from infra?
The core sector also. The core sector is also having some opportunities. And I would say that I think the kind of traction which we have seen in the last quarter and even the early months of this quarter, it appears to be universal.
Broad-based.
Very, very broad-based.
And with regards to the much talked large retail chain account, do we have exposure to that account?
We have the exposure and we are fully provided for that.
Okay.
Almost fully provided.
You, sir. Thank you, sir. That is all from my side.
Thank you.
Thank you. The next question is from Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. I have a couple of questions. First is, sir, we have seen around 1,490 crores of MTM depreciation this quarter. Is this mainly pertaining to GSEC bonds or what is there?
The investment depreciation, the core investment depreciation is only about 60 odd crores. The remaining is the accelerated provision that we have made on the security receipts that are maturing over the next 2 to 3 years. So since SRs are held as part of investments, so it is reflecting in investment depreciation. But investment depreciation per se is about 60 crores.
Sure, sir. Sir, if you can highlight what is your gross book value of security receipts, and after this lumpy provisioning, how much we have the total provisioning there? I mean, the gross book value of
8,600 crores. 8,600 crores the gross SR, and now we are provided up to 87% of the book.
Understood. And sir, on this MTM now, if the GSECs were to go up or if were to harden, how? I mean, what is our threshold of the investment AFS book? I mean, till what yields do you are protected in some sense there?
We are protected till about between 6.95 and 7.
Understood. Great. And sir, just correct me if I am wrong. If I were to see your AFS details that you had given, I think you have given very beautifully detailed AFS breakup. But if I were to understand that, let's say your sensitivity of interest rate, what is the number right that I should be multiplying SLR into AFS, which is like 41%, and then the entire AFS book, which is your GSEC, T-bills, corporate bonds, SDL, all would have more or less similar impact. Is that the understanding right?
So the impact won't be different because the way the yields have moved currently, they would have moved more on the longer end. This is what has happened over the last 3 weeks or so. So the impact will not be uniform across the portfolio.
No, right. Assuming a parallel shift in the yield curve, would the entire AFS book that you have shown, GSEC, T-bill, corporate bond, SDL and everything, that would have, let's say MTM requirement, right? The entire AFS book.
Yeah, so above a certain threshold, our PV01 is around 110.
Okay. Sorry, so what is 110? Sorry, sir.
PV01. PV01.
Okay. I did not get that. Anyway, okay, and this is like 41% of the entire SLR investment, right? That is the way to read this, right? 11 lakh crore into 41% is the AFS book.
No. So our total investment book is in excess of 14.5 lakh crores. 8.5 lakh crore is the HTM, and our AFS is about 6 lakhs.
Understood, sir. Okay. And the other question was, sir, on growth, on corporate growth specifically. So I think Chairman mentioned that, there is, of course, the lower or the utilization have not been that great. But it looks like that we are losing out market share as compared to peers, especially on the corporate side. So is this like a conscious strategy that you feel that the pricing is not that remunerative enough, or how are you seeing this space, especially the market share loss here?
So when it comes to the corporate credit growth and the market share, we are very mindful, as I mentioned in my opening remarks also, about the price points at which we would like to lend, and also in terms of the industries where we would like to lend. We don't want to get into indiscriminately into all sectors. Where we want to lend, we have to be very mindful, and we have got a risk appetite. Accordingly, we will lend.
Understood, sir. And the last question, sir, is on ECLGS. There looks like last quarter was some 24,000 crore, and this quarter it has gone up to 31,000 crore. So like 25% increase in this quarter. Any specific reason, or this was just because the ECLGS 1.0 scheme was liberalized, so maybe that is causing this spike?
Yeah, it is both a combination of additional financing which was allowed under the ECLGS, and also the extension to certain new sectors together contributed to this growth.
Understood, sir. And thank you very much, sir, and all the best.
Thank you.
Thank you. Our next question is from Mahesh MB from Kotak Securities. Please go ahead.
Good evening, sir. Just two questions from my side. One is, how are you looking at your capital adequacy number? In the sense that if growth does come back, would you still want to look at a possible capital raise anytime soon, or you think that the internal accruals are still quite sufficient to manage the near-term growth numbers?
See, as far as the growth which we are looking at, 9% kind of a growth, I think with the clawback of the profit which we'll have at the end of the year, we will be comfortably placed. But yes, we'll wait for the growth trends in the coming financial year, and accordingly we'll take a call on the capital raise.
So just one additional question. You kind of indicate that your near-term trajectory on ROEs is around 15%. Does that mean that if credit costs were to go, let's say, below your long-term averages for a certain period in time, would you allow the ROEs to move higher than 15, or you think that you would kind of keep it at those levels at least for the foreseeable future? What is your internal assessment on how do you want to look at this?
No, we would like to keep ROE above 15. That is not that we don't want to go beyond 15. That's very clear. And but yes, of course, I think many of the calls will be taken at the material point of time.
Okay, I just kind of clarifying this. If let's assume that your loan growth was still running at a, let's say, a 10ish to, let's say, 12% kind of a number, and ROEs are still quite high. You're still quite comfortable kind of keeping a high ROEs over pushing growth. Is that the way to see it?
The balanced one. So actually, if you have a look at our numbers, we should be at about 12% as far as tier 1 is concerned. Our risk-weighted assets are currently at around 55%. So there is enough capital to take care of growth. So on the return on equity side, I mean, we haven't really thought very deeply on the fact that whether we should hit 16 or 17. But suffice to say that right now we are pretty well placed.
Perfect. This is very useful. Thanks a lot.
Thank you. Our next question is from Jignesh Shial from InCred Capital. Please go ahead.
Yeah, thanks for the opportunity, sir. Just the same thing I wanted to check. So there is, with the kind of credit growth of around, a single 9% to 10%, there is no immediate capital raise is being looked into, right? That is what has been mentioned. Is that correct?
Yeah, that's right.
Okay, that's important. Then number two, can you give some more numbers or throw some more light on your digital initiatives, specifically how the sourcing and all on the MSME front is happening, or even the personal loan front is happening. If you can give some more light on that would be really useful.
Yeah, digital, as far as the YONO app is concerned, it's doing pretty well. About 4.5 crore people have already become the registered user of our YONO app, and we have, when it comes to the online banking, over 9 crore people are using this and the online banking. So that is something which we are seeing. Almost about 30,000 odd savings bank accounts are getting opened on a daily basis. And we have also seen a decent growth in terms of our PAPL, which is pre-approved personal loans, which we are dispensing. Almost 40,000 crore worth of loans have been dispensed in this financial year using this particular app. And when it comes to the financial superstore, we are in a position to sell about almost 4,000 crore kind of a mutual fund, 3,300 crore worth of mutual fund sales we have done with the help of this app. About 17 lakh policies, personal accident policies we have sold with the help of this app. And the growth actually in the mutual fund sales have gone up by almost about 5 times on a YOY basis. I think going forward, in fact, we are already using this app for doing our KCC reviews and also the KCC gold loans, agri gold loans also we are sourcing with the help of this app. Almost about 10,000 worth of agri gold loans are sourced in this with the help of this app. So that's how things are, and I'm quite hopeful that going forward, the way we are leveraging our analytics, will be in a position to offer many more such functionalities with the help of this YONO app.
Okay, that's quite useful. And just lastly, reconfirming, roughly 22% of your loan book is linked to external benchmark rates, right? That's a T-bill.
22%, yeah.
Of it. So in case of any movement happening on the T-bill side, immediately your 22% of the book will get repriced accordingly.
Yeah, that's right.
Oh. Okay. Thank you so much. Thank you. All the best.
Thank you. The next question is from Gaurav Kochar from Mirae Asset. Please go ahead.
Yeah. Good evening, everyone. Thanks for taking my question. Just a couple of questions. First one is, your outlook on credit cost for fiscal year 23, given that we've seen a very good sort of credit environment. Asset quality has held up quite well despite 3 waves of COVID. So just wanted some color around that. And in that context, if I look at the write-off pool, it's at around 1,80,000 crore today. So what kind of recovery should we assume going ahead from that pool? And on a net basis, are we looking at a very benign net credit cost for fiscal year 23? That's the first question.
The credit cost, our endeavor would be to keep it around the level, but yes, of course, the guidance, when it comes to guidance, I would like to believe in under promise and over delivery. And with that in mind, I would not like to change the guidance, but nevertheless, would like to keep it around the same numbers, credit costs. That is one. Secondly, your question relating to the recovery from the write-off pool. Generally, our experience is that we are in a position to recover about 20% of the write-off pool. So that is something which you have seen over the past. So I think it should be around the same level.
Okay. So just to put numbers into context, 1,80,000 crore pool, roughly 36,000 crores in the next, say, maybe 2 to 3 years is the sort of recovery that you would be targeting from the existing pool.
And also it differs also depending upon the security if at all it is there. But
Sure.
yes, the next 2 to 3 years on a rough basis we can assume that.
Sure. That's helpful. And my second question is with respect to the, if I look at the system credit growth data that came in every fortnight, in the last fortnight of December, I think there was a huge bump up in credit, around 3.7 trillion. So, and for us, I mean, the credit growth is also strong at 5.5% sequentially. So whether this large chunk of this growth in this quarter came in at the last fortnight, is that a fair assumption? And in that context, will it be fair to assume that the interest income, the interest on loan benefit for this growth will be more visible in 4Q? Is that a right way to look at it?
So you're right, but I think in our case, the growth which you're thinking in terms of the last quarter, it was not really so. I would rather say that we have seen the growth coming in the early part of January, which of course we'll get to see in the current in the current quarter. So I think hopefully we'll have decent numbers to talk about when we close this quarter.
Okay. That's great to know, sir. And on the incremental yield versus the on-book yield on loans, how high is the incremental yield given that large part of growth is coming from retail and within retail the unsecured retail? So any color on what would be the incremental yield?
Actually, retail growth is about 14-15%, but what we have observed is that the chunky growth comes from the corporate book, and if at all chunky growth comes from the corporate book and a significant portion of our loan book is now linked to external benchmark or MCLR. So that also will be the guiding factor in terms of the kind of earnings which you will get to see. About 50% is MCLR and about 22% is external benchmark link rate. So that is how our book is stacked up.
Right. So, sir, just to stretch this question a bit, on margins, roughly 50% plus 22, that's 72% of the book is externally linked. And if we are in a, say, rising rate environment and Indian interest rate has to go up, say, next 12 to 18 months by another 25 to 50 basis points. In that backdrop, on the liability side, given that, the SAR rate would be broadly fixed and term deposit rates, assuming the CD spread right now that you have is significant, so you need not raise the term deposits over the near to medium term. So taking that context, what kind of margins you're looking at from current levels? Can we assume a 20 basis point, 15-20 basis point of margin improvement over the next, say, 12 months, 24 months?
Yeah, I think there are many variables, so we'll have to wait and watch. But nevertheless, our effort would be to keep the NIM at around the same level which where we are today. And if at all there will be scope for improvement, we'll certainly improve there.
Okay. Thank you so much, sir, and all the very best.
Thank you.
Thank you. Next question is from Manish Oswal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity, sir. My question on our interest income during the quarter. So we have a growth. We saw a growth of 5% on 5.5% on loan book side, but NII on the declining side. So any one-off in the previous quarter to this quarter, sir? Can you clarify on that?
It would be IT refund would be the one.
What is the quantum, sir? Delta quantum. What is the delta movement?
1,900 crore.
1,900 crores. Okay, sir. Thank you.
Thank you. Next question is from Ashoka Ajmera from Ajcon Global Services. Please go ahead.
Thank you for this opportunity. And congratulations, Tara Saab and the entire team once again. You have made the operating profit of 18,521 crore, making the bank to be, making a profit of 75,000 crores on the annualized basis if you take it, or it will go rather more, which is really commendable. And even on the other front of the various ratios, NPA, gross NPA, net NPA, your PCR, ROE, fantastic results. Having said this, sir, I would, because most of the questions have already been covered, I would, sir, just seek your view, though the time has been very short from the budget to now. So with this, RBI supported digital currency movement now coming in, maybe it may take some time, but yes, it is going to be there. Sir, have you got any time to think over it to how it will disrupt the entire banking system? Whether the deposits will flow out of the banking systems, whether, what kind of impact it can have, because it is going to come, that is for sure now. So this is my first question, sir. Not only a question, I just want your views on this.
It's too early and too premature unless and until we get to understand what the size, dimension and nature of this particular concept is going to be. But nevertheless, one thing I would like to mention that I think digital is becoming a default option in the economy. And with the digital becoming the default option, if at all there is any digital currency, so as against the physical currency, the movement is going to be through the digital currency. So that's how I really understand. But yes, its various dimensions in terms of store of value, transaction value, and how will it be accounted for when it comes to the country's GDP is concerned. So all those dimensions I'm unable to really comment. I'll ask my colleague Mr. Ashwini Tiwari to come in and give his views. Yeah.
Yes, sir. First thing we have to remember is that the Reserve Bank is a conservative institution. It is not an institution which will disrupt the system. Second is that the digital currency, the central bank side, it's live only in 2-3 countries. You have Nigeria with e-Naira, you have Bahamas, and a few other smaller countries. China is still testing, though it has been very advanced in terms of testing. And one of the leading reasons for China to do this was because the big tech in China and the wallet-based funding had become really, really powerful and very large across the system. So that was their motivation. In India, what we have is that the payment system is already very evolved. So the digital payments through UPI and through NPCI are really, really significant part of the system. And since the inclusion is already happening through these channels, the motivation to that extent from the digital currency is relatively not that much. So the use cases which RBI has to find for digital currency should largely be in the wholesale space. And therefore, we have to wait and watch as to what RBI thinks about the objectives. It is not a currency for the currency's sake. It should be for what objectives should be done. So we'll have to wait and see. RBI has reached out to some players to actually take their inputs, and there will be committees, etc., which will be set up. So we'll see how it goes.
Okay, so my next question is on now this NARCL, National Asset Recovery Company, now finally everything is approved and it is now in place. So in this quarter, that is the January-March quarter, how much are we thinking like? Because I think it has been overall size of this first tranche has been I have been reading is reduced from 84,000 crores to some 50,000 crores. So how much will be of SBI in this, the gross value-wise?
Around 20,000 crores.
Total. Both together. Phase 1 will be about 11,000.
Phase 1 will be about 11,000 crores.
Yes, sir.
Over.
Okay. And we feel that the realization is about that same, that 20-25% valuation, and 15% of that is actually cash coming in.
No, it is, the structure is going to be the same, 85% SRs. It will be government guaranteed SRs, 15% is going to be cash. So that is the kind of a structure which will be there.
So now coming to, sir, this budget announcement, a very bold, the capex announcement of almost about increased by about almost 1,95,000 crore, making it to 7.5 lakh crore. So from that, sir, don't you take the cue that tremendous work is going to happen in this, and the bankers are going to play a very, very major role in this? So is it not the time to again relook at our target of 9%, or going forward, even from the capital adequacy point of view, also the huge opportunity will be there in place. Because a huge investment will be built up along this line. So what,
I agree with you, and the kind of a capex aspirations which have been indicated in the budget, we are very much prepared for meet those kind of growth requirement of the economy, and invariably it gets spread over a period of time. So I think we will be very closely watching the situation, and if at all there will be need for raising capital, we'll certainly look at it. But as of now, we will be plowing back our profit also at the end of this financial year, and thereafter we'll look at it that how things really look like.
Thank you. Mr. Ajmer, I request you to join the queue for any follow-up as we have several participants waiting for their turn. Thank you. The next question is from the line of Saurabh from JP Morgan. Please go ahead.
Sir, just two questions. One is the current account has gone down quarter on quarter. Could you just highlight what's happened there, current account deposits? And the second is, sir, on this NIMs, just from the understanding I've got is essentially that you do get a positive benefit from rates given the orientation of the book, but you would, in the interest of loan growth, would look to pass on some of that benefit back to consumers and keep the ROAs around that 0.81% level. These are two questions, sir. Thank you.
See, when it comes to NIM, of course, absolute credit growth. Apart from that, the yield on advances. Yield on advances have come down in the system as a whole. So we are very mindful in terms of the kind of underwriting which we will do and at what price point we will do. So we'll keep that in mind. So absolute growth will come, but maybe at a price which may not be in tandem with what we have seen in the past. But much of it will be a function of the market. So I think that is one part.
Current account.
And current account, of course, is it is always it is something that's a function of the volatility in current account is a reality. So if at all economic activity improves, people don't keep the money into the current account, they rather consume. So that I think we'll have to live with.
Okay, so there's no one-off in this 250 going down to 230.
No. It is. Towards March it always sells also, because when government releases a lot of payment, so it goes up also. So that's a reality. That's okay.
Understood, sir. Thank you.
Thank you. Next question is from Manish Shukla from Axis Capital. Please go ahead.
Good evening and thank you for the opportunity. First question is on the loan book. You said about 22% is EBLR. Could you give the breakup for the rest? How much is MCLR and how much is fixed rate?
49. MCLR is 49%. 49%
is fixed rate.
Pardon?
Sorry, and balance rate loans, is it?
Fixed rate loans and also base rate, some small quantity.
Fixed rate is about 17%.
Okay, all right. The second question is that in a scenario where interest rates have already started rising, on balance sheet we are sitting on almost 31% investments, of which about 6 lakh crores is AFS. So A, it is a lower yielding book, and B, we are in a rising rate scenario. So how comfortable are you with this mix of assets between loans and investments?
See, I think since our book which is linked to MCLR and EBLR are about 72%. So in the rising interest rate scenario, we will not have much of a challenge, and even fixed rate also there is a structure which allows us to revisit the interest rate. So that's not as much of a worry. As far as the investment book is concerned, we'll have to wait and watch how really things look like, and thereafter we'll be taking appropriate call. But nevertheless, as far as our duration is concerned, the modified duration for us is about 1.97. So we are, till the month of December, we're quite fine. Even now also, as we speak, we are okay. But let's see how the things look like going forward.
Sure. The second question, sir, is on COVID provisions. You are about 6,000 crores. What are your thoughts around either carrying it as is or utilizing it going forward?
So in this quarter we'll decide, depending upon the evolving situation, we'll decide that, but we will surely make some provision and use this amount.
Okay.
In whatever way it is prudent.
Okay. And the sectoral exposure shows that the telecom exposure is up sharply YOY. What is the nature of this? Slide number 10.
This is something, it is essentially to AAA companies.
Sorry, I didn't catch that.
It is essentially to the AAA companies, well-rated companies.
Okay. The really last question, for at least 2 or 3 quarters now, international loans have been growing faster than the domestic loans, and clearly that is a drag on net interest margin. So just wanted to get your thoughts on how you see that opportunity between additional business versus drag on net interest margin.
I think these are all short-term financing which has been done, and of course, apart from that, we have done some not bilateral, it's all syndicated loans, secured loan factoring, which we have participated, and we have introduced a new line of activity which is factoring. So that also helped us in ramping up this book.
And when the interest rate inches up, they can be redeployed quickly. So the current short-term book,
yes,
it can be redeployed into better yielding assets quickly.
And in good rated assets. So
yeah, it's a well-rated assets also.
Thank you. Mr. Shukla, requested to join the queue for any follow-up. The next question is from the line of Krishnan from HDFC Securities. Please go ahead.
Yeah, many thanks. I had a couple of queries. One was around the express credit segment. There's been a furious pace of growth there for a few quarters now. Just want to understand your sense of what kind of end use are you seeing here? What kind of ticket sizes are these typically? That's one. The second is, now obviously private sector banks are allowed to compete for the government business. Just wanted to understand your thoughts around how the competitive intensity is and where does SBI continue to have a right to win?
Well, of course, when it comes to the unsecured PAPL is concerned, you wanted to know the ticket size, average ticket size.
Yeah, can I just?
Please.
Yeah, I think 2 questions what you asked in terms of the growth potential of that. I think we've been consistently maintaining that this is coming mainly from our salary package account holders. We have about 1.7 to 1.8 crore salary account holders, and our penetration in the express credit is just about 25 to 26%. So there's a good potential still available to be explored there. And yes, it is a competitive area, but we have been devising very, very dynamically all our salary packages, and to be, to continue to be extremely competitive in this area. And as far as ticket size is concerned, it ranges from 6 lakhs to 8 lakhs.
Anything around the end users at all? I mean, what are these typically being used for, just to get a sense of where consumption is heading?
This defense salary holders, when they go home, they will have some repairs of homes and all. This is a very easily available loan. So normally they take for this kind of expenses, some home repairs.
These are all consumption expenses, especially
property. Consumptions or margin by agricultural land also.
No, they don't mainly put in assets. It's generally the consumption expenses.
marriage also.
Marriages.
Thanks. Just on the competitive intensity around the government business.
Yeah, that's what I said.
Government finance requires a lot of investment in terms of manpower and machinery.
Technology.
So, and also, I think we are quite competitively placed.
And the income has been holding up.
Yeah.
Understood. That's helpful. Thank you.
Thank you.
Thank you. The next question is from Anand Dama from Emkay Global. Please go ahead.
Yeah, thank you for the opportunity, sir. Sir, one thing, a lot of private banks have given how much is the tech spend as a percentage of OPEX. Is it possible for you to give some ballpark figure over there?
Tech, sorry?
Okay, fine. At some stage, we will start also introducing.
Okay, sir. Any ballpark figure, like any percentage that you can give?
I would not have anything on this.
Okay. Sure. So second is on a restructured portfolio. So you said that your restructured portfolio is somewhere about 40,000 odd crores. How is that portfolio behaving? Because if you look at the non-restructured portfolio, the NPA certainly are coming off. Even your agri portfolio did well. But your restructured portfolio has a lot of SME pool as well. So how is the payment performance over there, whether customers are paying and what kind of relapse rate or the NPA formation that you expect from the restructured portfolio as and when the moratorium ends?
So far, we have not seen any unusual trend in terms of either slippages or SMAs. I think it is the usual performance so far. So I don't think there is any concern, but of course, a lot of MSMEs also got some moratorium. So once the moratorium goes off, we'll have to see how the behavior is there. But so far, there is no untoward kind of uptick in the slippages.
So when basically the moratorium is going to end for most of the SME customers?
So the different
No, it would be a different point of time.
Different moratorium. Yeah. It's very difficult to say that, somebody after for 6 months, somebody after for 12 months. So maximum of 2 years was permitted. So different MSME customers have taken different moratorium.
Okay. Sure, sir. Thanks a lot.
Thank you. Our next question is from Abhishek Khanna from Jefferies. Please go ahead.
Good evening, sir. This is Prakhar. Just a couple of questions. While I appreciate you don't want to disclose your gross slippage numbers, which all the other banks in the industry do that, but if I'm looking at the credit cost number for the quarter, it is sequentially up 15%. And would it be fair to see that on a quarterly flow basis, your net slippages would have been higher by a similar percentage, more or less?
Not really. It is whatever additional provisions have been done on account of aging would be one of the components for the credit cost, which seems to be a little higher.
Because the coverage last quarter improved by 200 basis points. This time it has improved by 100 basis points. So, last time I think you would have covered more ground than this time. That's why I was...
There is hardly any slippage, my dear sir. There is hardly any slippage this year, this quarter. Why don't you look at that number, please?
I understand, sir. I just wanted to get a broad sense because, we don't have the gross flow number. We get the cumulative number.
We have been giving net slippages always.
And we want to be consistent.
And we want to be consistent on that. I think we should be respectful about that decision. What is that?
Sequentially also it has come down, sir.
Yeah. It has actually come down from 0.61 to 0.57.
Thank you, sir. Question my answer. Thank you.
Thank you. Our next question is from Nitin Agarwal from Motilal Oswal Securities. Please go ahead.
Yeah, hi. Congrats on strong results and thanks for the opportunity. So a couple of questions. One is we have been reporting very benign levels of slippages for last 2 quarters now. And 4Q is usually a strong quarter from asset quality angle. So how do you see the sustainability of this current slippage run rate?
Hopefully we should be in a position to maintain this trend.
Okay. And secondly, on the credit growth, we have seen a good pickup in the system, but in the next fortnight there has been a pullback also, which is almost half of the addition that we saw in the quarter end period. So how has been that for SBI, and how do you see the growth momentum sustaining over the 3Q addition that we have seen?
In the sustenance of the trend which we saw till the month of December. Rather, in certain respects, I would say it is even a stronger one which we have seen here.
So we have not seen any pullback as such that the system has reported?
No, not really.
Okay, sure, sir. And so lastly, the performance of our general insurance subsidiary has been under pressure, and this quarter we reported a loss there. So how do you see the claim ratios trending in this business? Any color on the performance and the profitability outlook if you can share?
I think it's a industry level trend. So that's we are part of that, and maybe going forward we should be in a position to take care of this.
Sure, sir. Thanks so much.
Thank you.
Thank you. Our next question is from Nilanjan Karfa from Nomura. Please go ahead.
Hi. Am I audible?
Yeah, please go ahead.
Yeah, sir, I just want to go back to a strategic question. So, look, sir, we are probably running the lowest cost of deposits, and as rates are hardening, don't you think this is the right opportunity to continue to pass on some of the rate benefits, maybe in terms of fee, maybe in terms of spread, and get a greater wallet share of the customer? And also considering that our credit costs are probably going to run much below the historical trend. Is this kind of a thought is something that has that has been discussed, in the top management, and any strategic intent on this side, sir?
We are very closely watching the situation, and I think last month we had increased our term deposit rate by 10 basis points. So we are very closely watching the situation, and accordingly we are taking the steps.
Okay. Have we reduced any charges on, let's say, LCBGs, usually the non-funded side? Have we done any tinkering on that side, sir?
So it's all very customer specific, and depending on the wallet share and depending on the volume of business that the customer would give us, this is a continuing process. And it is also a response to competitive pressures that we get from other banks.
Right. But sorry, if I have to extend this question, are you seeing a lot of competition from at least the top?
Yeah. We are all playing in the market, so competition is bound to be there. Nothing unusual. Nothing unusual. Competition is part of the game.
There's no trend. Of course, to respond to your question differently, there has been no revision on the card rate. But on a case-to-case basis, decisions are always taken, and that has been the usual trend. There has been nothing significantly different over the previous quarter.
The liquidity was very good till
And as regards other fees like processing fees on retail and all, there are several campaigns that run for shorter periods where the maximum benefits are passed on to the customers.
Right. That's very helpful, sir. Thank you so much.
Thank you. Next question is from Adarsh Parasrampuria from CLSA. Please go ahead.
Hi, sir. Congrats on good numbers. Couple of questions. One, does SBI even need to raise capital over the course of the next 12 months? Because from March, if you add back pro forma profits, there has been a 30 basis point improvement in our CET1 level. So just wanted to understand, can you self-finance your growth because ROEs are better than growth? So if you can give your sense.
I think we'll be taking the call in the next financial year. But as of now, we feel that first half of the next financial year, whatever growth is likely to be there, that can be adequately supported by the capital which we have.
Got it. And sir, the next question, it's been touched upon by a few participants, but that's been a bit of a drag on the system, has been the credit growth, right? Some pickup that we've seen. What is your sense of credit growth? Which areas do you think certainly you are seeing momentum in terms of how clients talk to you, that is improving or not? Or because we've been in single-digit growth for a long time as a system, right? So.
No, we have started seeing as I mentioned, that the underutilization has come down by almost about 900 basis points as far as the working capital is concerned on the corporate side. And similarly, when it comes to the term loans, it has also come down by about 100 basis points, unavailed term loan component. So that way, there's a traction which we saw in the month of December, in the December quarter. Thereafter, at absolute level, we have seen much better credit growth in the month of January, though despite the fact that Omicron had affected partly the various parts of the country. But nevertheless, still we could see a much better growth. So going by the January trend, if at all that is sustained, we expect the credit growth in this quarter to be much better than what we saw in the October-December quarter. And I feel that that kind of a behavior should be sustained in this quarter. And apart from that, now the budget has also talked about the investment into the infrastructure related areas. So it will also open up many opportunities, and also many of the industries which had already hit the capacity utilization of 100%, they will probably augment their capacity too. The core sector being one of the major ones. So hopefully we'll get to see much better credit growth in the coming financial year. But yes, of course, we'll wait and watch for the early trends to be seen.
Got it, sir. My last question is on the SME credit. Retail and corporate has held up very well. SME, there was a lot of dispensation, right? Incrementally, CLGS lending, restructuring. So what will be your expectation? Because that could be one risk for the next maybe 12 to 18 months in terms of asset quality. What would be the expectation?
We are trying to get into activities which would be cash flow based financing, and also into better quality of SME lending, which would be essentially into dealer financing, vendor financing, etc. So that is one of the focus area for us, and to that extent, I think we should be in a position to improve the quality of the book and the SME.
So from the restructured pool and where we given ECLGS, we wouldn't see too much of a risk?
Not really, because if you will look at it, our book would be around COVID book 32,000 crore. 32,000 crore. We already have got the COVID version of about 6,000 crore. And what we have seen from the past is that the PD is generally around 30%, but this book is very unusual because this was a very unusual circumstances in which the restructuring has happened. It was essentially attributed to the disruption in the cash flow. As the cash flow gets repaired, the stress also goes out, and we have seen that some of the people start repaying and don't really avail the restructuring benefits for the full term. So I think we'll have to wait and watch, but nevertheless, we feel that we have insulated the balance sheet.
Just to supplement what I think out of this 32,000 crore restructuring book which we're talking about, the MSME is just about 12,000. So in that also we are not seeing any untoward kind of behavior in terms of the slippages. So there's no great concern on the restructuring book on the MSME. So I think this is one thing which we should remember.
Thank you. Our next question is from Sumit Kariwala from Morgan Stanley. Please go ahead.
Yeah. Hi. Hello, everyone. I just had one data question. What is the yield, incremental yield on the unsecured loan book, if that's available?
I would not have that number with me.
No problem. No, I'll take that offline then. Thank you.
Thank you.
Thank you. Ladies and gentlemen, due to paucity of time, that would be our last question for today. I would now like to hand the floor over to the management for their closing comments. Thank you, and over to you.
Thank you very much for the time taken by all of you on a Saturday evening. Look forward for your continued support. All the very best. Enjoy your weekend. Stay safe. Bye-bye.
Thank you very much. Ladies and gentlemen, on behalf of State Bank of India, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.